Chapter 4, how one widow paid $9,623 in tax while another paid nothing, even though they both had $80,000 of income. As we discussed in the previous chapter, if a married couple's provisional income is less than $32,000, they pay no tax on their Social Security benefits, none. However, for a single taxpayer, if provisional income is greater than $34,000, then up to 85% of their Social Security benefit will be subject to tax. Let me just show you again. If you're married filing jointly and you have $32,000 of Social Security, none of it's subject to tax. However, if you're a single taxpayer and you have $34,000, just $2,000 more, your Social Security benefit is going to be subject to 85% tax. 85% of your Social Security benefits will be subject to tax. Tell me that's not crazy. So let's say you're a single taxpayer and have $30,000 distribution from a traditional IRA, in addition to your other $30,000 of Social Security benefits. In this case, your provisional income is $45,000. You will pay tax on your Social Security benefits because provisional income is half your Social Security plus any other income you receive, Roth distributions excluded. Now, say that $30,000 IRA distribution came from a Roth. In this case, your provisional income is only $15,000 because Roth IRAs are, again, not included in the calculation. So in this case, you pay no tax. It's pretty amazing, actually. So let's compare Jane and Judy. And they both have $30,000 of Social Security, and they both have $30,000 of IRA distributions. But Judy's IRA distribution comes from a traditional IRA. Jane's comes from a Roth IRA. So 30,000 Social Security, 30,000 IRA for Judy equals 60,000 of total income. Jane has $30,000 of Social Security, 30,000 of Roth distributions, 60,000 of total income. Judy's IRA is from a traditional and Jane's is from a Roth. So let's see what it looks like when it comes to taxes they pay. Judy has taxable IRA distributions of $30,000. Her taxable Social Security, because we already did the provisional income test, is $13,850. Add those two, $13,850 to $30,000. That means her adjusted gross income is $43,850. Subtract her one standard deduction. She has taxable income of $30,550, which means her tax due is $3,476. Jane, nothing, no tax due, because she does not have enough Social Security income to be subject to taxation, and Roth IRAs are not as well. By having a traditional IRA, Judy has to pay $3,476 more in tax over the course of 10 years. Because remember, my friends, this is just this year. She's going to continue to pay that tax each and every year. And we're talking at least $35,000 more in federal income tax than Jane will. And since most state income taxes are based on taxable income calculated for a federal return, when you factor in state income taxes, this figure may even be higher. So just think what you could do with an extra $3,476 each year. That could be the premiums for long-term care. It could be your car payment, Medicare premiums, your Medicare supplement, or your Medicare Part C, your Medicare Advantage. It could be any of that stuff. That is your money that you are losing because you had a traditional IRA as opposed to a Roth. But wait, there's more. Ever since John died, Judy has wanted to take her daughter on a month-long cruise vacation. No time like the present, she said. So she takes an IRA distribution of $50,000 to pay for the cruise. Much fun was had. They had a great time. But smiles turned to frowns when Judy gets a call from her tax guy the following year. She owes almost $10,000 in federal income taxes. $10,000, which is nearly $7,000 more than the year before, even though she only increased her gross income by $20,000. Her income went up by $20,000, which is the 33% increase. But her taxes went up by $7,000, which is a 250% increase. How does this happen? Well, let's break it down step by step. Judy's total income, Social Security, $30,000. Traditional IRA distributions, $50,000. Her total income then is $80,000. Now we got to determine her provisional income. We take half the Social Security benefit, which is $15,000. We add it to her traditional IRA distribution, which is $50,000. Her provisional income is $65,000. And what we do is we take the first $25,000 of that $65,000 in provisional income. That's not subject to any taxation. Between $25,000 and $34,000, that's $9,000. 50% of that, or $4,500, is included in her taxable Social Security benefit. Anything above $34,000, which in this case is $31,000, 85% of that, again, $25,075, is included in her taxable Social Security. So we take the $4,500, we add the $25,075, we have a total Social Security subject to tax of $29,575. However, by law, by federal law, thankfully, only 85% of your Social Security benefit is subject to taxation. You can't have more than that. So we know for a fact the first 15% that you receive in Social Security will not be taxed, for a fact. So in this case, she doesn't have taxable Social Security income, $29,575. She only has $25,500 of taxable Social Security income. Thank goodness for little miracles. But now we got to determine her tax. All right, so Judy has $50,000 of taxable distributions from her IRA. Her taxable Social Security is $25,500, which means her AGI, adjusted gross income, is $75,500. We subtract out the $13,300 for her standard deduction. Her taxable income is $62,200, which means her tax is $9,623. She is stunned to learn that by taking $20,000 more from her IRA, she raised her taxes by $6,146, which is an effective 32% tax bracket or tax rate. Now, I can hear you asking, wait a second, Josh, she's only in the 22% tax bracket. How is her effective tax on this distribution 32%? This seems fishy. Folks, I just got to pause here and tell you how fishy this is. All right. This is fishy indeed. And this is regressive taxation. You might be familiar with progressive taxation. The more money you make, the more your tax rates are. That's progressive. And that's the way the tax code has been set up for many, many years. When it comes to Social Security taxation, it is regressive. The less money you make, the more tax you pay. And I'll share with you right here. Judy is being taxed twice on the same income. Those IRA distributions are subject to income tax, but it also made more of her Social Security benefits tax as well. When Judy only had $30,000 IRA distribution, just $13,850 of her Social Security benefit was taxable. But now with $50,000 IRA distributions, her taxable Social Security benefit jumped by $12,000 to $25,500. Her total taxable income then more than doubled from $30,550 to $63,500. You got to think about this. Her taxable income doubled from $30,550 to $63,000. A 33% increase in gross income caused a 100% increase in taxable income. A better example of double taxation you're not going to find. I cannot stress this enough. Old Judy, just a widow. She took out $20,000 more than the previous year, which means her taxable income went up by $23,500. But she only took out $20,000 more. It's crazy. The tax law is regressive, and it affects widows in particularly, and widowers, but most people are widows. Now, how the Roth saves the day. And I guarantee when you've done your calculations of the Roth versus the traditional, no one ever told you about this. Let's look at Jane. Remember, she also increased her income by $50,000 to take her daughter on the same 30-day cruise as Jane did. But remember, Jane had a Roth IRA, not a traditional. So what happened to her taxes? Nothing. She nets $80,000 and she still pays no tax because her provisional income is still under the threshold for Social Security and the Roth is not subject to taxation. Thus, $80,000 of net income, no tax due. And we can just go through the numbers if you like. $30,000 Social Security income, $50,000 Roth IRA distributions, total income is $80,000. Determine provisional income. It's just half of Jane's Social Security, which is $15,000. All other income is zero. Tax exempt interest is zero. Provisional income is $15,000. And if provisional income is less than $25,000 for a single taxpayer, she pays no tax on Social Security, and she pays no tax on her Roth IRA either. So she pays no tax on $80,000 of income, whereas Judy pays $10,000 of income taxes on the exact same amount. Who would you rather be? And secondly, as you're contemplating doing a Roth IRA, and we're going to even talk more about Medicare in the next chapter, you've got to understand the double taxation, the effective rate of $1.85 more in taxable income for every $1 you take out of your Roth, of your traditional IRA. It's absolutely absurd, but absurdity never stopped the tax man from taxing you. And that's just the tax code we're dealing with. So remember that. The double taxation for Social Security income is horrific. All right, so stay tuned to the next chapter. We're going to talk about how this affects your Medicare premiums as well.